Hello.
Hello. Okay, the music's quite loud. I'm like, am I supposed to be talking now?
Oh, man.
Oh, God. This is Showbiz. Welcome to Live TV.
People.
Hello and welcome. You're joining us live on the Investor Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose.
My name is Gabby.
And we are still trying to work out how to get our audio settings correct.
Well, to be fair, we keep changing it every week, so...
Yeah, that is true. That is true. You are, just so you know, touch that. You might want to bring it down a little bit on your microphone because it is...
Oh, I'm too bad.
You're coming in
Thank you.
hot. You're coming in
hot.
hot. If you're here joining us live today on YouTube for this YouTube live stream, make sure you let us know in the chat. Say hello. Let us know where you are. It's good to see familiar faces every single week. We do this live so that we can be with you, not just some kind of thing that you consume like a dirty crumpet on a Sunday morning. We actually want to be here in the room with you. Yeah, I mean, I don't know who eats dirty crumpets, but I prefer my crumpets toasted and clean. That's cool.
You do you.
Yeah, have your crumpets however you like them. But if you are here live, let us know in the chat. It's great to see you. It's great to interact. And of course, as always, we thrive on your questions. That's actually one of the main reasons we do this live, so we can foster a sense of community through interaction with you directly. So if you're here, let us know. Make sure to ask questions. And of course, before we get started, it would do us a massive favor if you could hit the like button. Now, hitting the like button does something really interesting. It's not just for us, actually. So here's a little interesting fact about the like button. When you hit the like button, YouTube will find other videos like this and send them to you. So if you like this kind of thing, then you'll get more of this kind of thing by hitting the like button. It also helps us as well. It helps us to get the show out. Gabby, how are you today? Where are you today? What's going on?
Oh, 3 questions in one. Sweet. I am well, thank you. Happy Valentine's Day to you.
Happy Valentine's Day to you too.
This is so funny. We realized, so I'm actually in Bali right now, which you know that, but guys, if you're listening, I'm in Bali. And we have pretty much spent every single day together for the 8 years that we have now been together. And this is the furthest time that we've been away. So I'm actually in Bali. My mum had a trip booked in Bali, and then her friend couldn't make it anymore. So here I am. Lucky 5 days for me. Sorry, Goose, that you get to stay in Phuket, so it's not that bad.
Yeah, it's not too bad.
It's not that bad. And the weather is very overcast, and it's probably going to rain, but we're in Bali. So
you've left sunny season and you've gone to the wet season in Bali, which is pretty funny. You may just want to quickly check I'm just sending you a quick message. You may want to check your audio settings again because it's coming through pretty hot.
Okay.
As well. So maybe just check to make sure you're going through the mic, not the headphones, because it seems to be coming through like super spiky and hot. Which is, fine and all good. How is Bali though? Our former home.
It's fine. I mean, no, it's it's fine. Because I got in late last night, and so I've just woken up, kind of set up for this, having a coffee. I haven't done any like walking around or anything. It's nice. Like it's not too busy from what I can tell so far. So no, it's good. It's good. We should come back here though. You and I.
To visit, not to live.
To visit, yes.
Yeah.
Awesome. Just an FYI as well. I'm actually just checking the stream on YouTube. I think we're about like 4-minute delay for some reason. So the chat might be a little, because our stream has only just started.
Fascinating.
So the chat might be a little difficult today, but
it's good. We can just get started. So if people can drop in their questions. Whilst I'm going to start a little bit of a preamble. Whilst I'm doing that, do you want to just double check to make sure that you're going through the mic and not your headphones? Just double check your audio settings just to make sure it's coming through tight, because it's still coming through a little bit hot. And for those of you who are persisting through this, thanks guys. This is what you get when it is live. You get it warts and all. That's part of the fun. It's part of the joy. So today we're going to be talking about how to know when to take profits. How to know when to hold, how to know when to sell, how to know when to rotate your capital into different assets. We're going to be talking about all this kind of stuff because I think it's a very important and very under-discussed topic. Everyone talks about investing. They talk about buying stuff. Buying stuff, get your money in the market, get it to work for you. which is very true. But also you need to also remember that nothing lasts forever. And so understanding how and when to take profits is one of the most important factors in your investing journey. Now, there is no hard and fast rule. This is the thing. So everyone needs to be able to understand the frameworks that are appropriate for them so they can make decisions based on their own unique set of circumstances. And it's going to depend on different assets, it's going to depend on your personal circumstances, your goals, all of this kind of stuff. Now, one of the things that I want to talk about, there's actually a whole bunch of stuff that I want to talk about, but I'm going to start by talking about the Warren Buffett fallacy. You've just made up that fancy title, the Warren Buffett fallacy.
Nice.
So if you hear Warren Buffett on any interview when he's asked for investing advice, what he will say is something to the effect of just put your money in the S&P 500 and just dollar cost average into the S&P 500 and let your wealth compound over time. And everyone looks at Warren Buffett and they look at how much he's worth, and they're like, oh my God, look at the effect of compounding interest, right? And that is true. Compounding, or compound effect or compounding interest, is one of the most powerful forces in the universe. It is phenomenal. But here's the thing. Warren Buffett says things like, go and just put your money into the S&P 500. But that's not what he does. He doesn't do that. And in fact, the most successful investors don't do that. Warren Buffett is currently sitting on $375 billion worth of cash, and he is not just putting that into the S&P 500 and letting it compound over time. What Warren Buffett does is he allocates capital appropriately based on assets that he sees to be undervalued or overvalued at any given point in time. He buys and he sells things, and he reallocates capital. So this kind of, and I remember Tony Robbins released a book a little while ago that became very popular and really helped to popularize the whole idea of the ETS versus active management type thing, which was called Money Master the Game. And it's a great book, right? But the reason he wrote that book, sorry, Tony, but the reason Tony wrote that book is because he wanted to create another income stream for himself by creating a joint venture with a fund manager, right? So he created a whole book about how you should just put your money into passive funds, not active funds. And that was his way of diversifying his own income. It's a great book, but it's got an ulterior motive, which is for him to create another business, right? Like, which is fine. But the whole point here is that the most successful investors know when to take profits, know when to buy, know when to hold, and know when to sell. And it really comes down to working out how do you kind of navigate through this at any given point in time. And I'm sort of waffling on a little bit here, but it's a topic that I'm really interested in and really passionate about, because there's so much emotion that gets caught up in it. But you don't go broke taking profits. It's one of the most important things. People have so much fear about getting started. So usually, like, getting started in investing in anything, there's so much trepidation. It doesn't matter whether it's someone who's investing their first $1,000 into buying some stocks, or someone who's buying their first investment property or whatever. There's so much fear and trepidation about getting started. And then there's also so much fear and trepidation around selling. But what if it goes higher? What if it goes higher? It's like, okay, so how do you weed through this? How do you navigate your emotions better so that you can become a master capital allocator and get to your goals faster, sooner, easier, and safer? These are the kind of things I want to dig into. Do you want to add anything to that, Gabby?
Yeah, I think the capital allocation is really the concept here, right? Because, like, historically, and the way that generally we approach this with our business is, like, it's always been get the acquisition right. And the focus is obviously such a big part in investing is making sure that you're picking the right thing to invest in. And that's the getting in. And as we've expanded and, matured in the business, it's like we realized that actually people need guidance on how to think about all of it holistically, because it's not just get in. It's like, yes, get in, pick the right things, but then is holding that asset the right thing for you to do, individual client with your individual needs and your individual circumstance. Really needing to think through that beyond just picking the right asset.
Yeah, I 100% agree. So, like, buying the right asset and the right asset in the right place at the right time is critical. But you could hold that asset for too long, and then it could become toxic.
Yeah.
Or, like, if you don't have the frameworks on how you're going to navigate that over the long term, then getting in at the right time can also be a moot point. So, if you buy I'm trying to think of an example that I can give, but I think, don't quote me on this, but I think IBM is probably a good example. Because IBM was like one of the biggest, most successful companies for a really long period of time. But if you still own the stock today, I think it's worth similar to if you'd owned it 30 years ago, because it's gone down so much, right? And so, not knowing how to have a framework to get out is a bear trap as well.
Yeah, it's interesting because I know, some people that I know have shares in different things, and they've got belief systems of like, oh, if I just hold on to it for long enough, it'll go up, right? It's the same. It's
Yeah,
the same with real estate. We have that mindset of over a long enough time horizon, it'll go up and she'll be right. Which, with this particular asset class, probably correct.
yeah.
But what else could you be doing with that capital?
But this is very super interesting point, right? And this goes back to if anyone goes back over the last few episodes, one of the things we talk about quite a lot is the different risk profiles between different assets, right? And so it does really depend because over a long enough time horizon, all companies die. Right. So like over a long enough there are some companies that are still around that have been around for hundreds of years, but they are the extreme rarity. So over a long enough time horizon, even the most successful company is going to die. There was a famous shareholder, like a shareholder meeting or whatever with Amazon years ago. I think it was in the mid 2000s, where Jeff Bezos famously said in a kind of an earnings call with all the shareholders and stuff there. He said Amazon might not exist in 30 years, which is true and a very pragmatic point of view on the world, but not what investors want to hear, right? Like they just want to hear like everything's going to be good. But he was very pragmatic in saying that, hey, Amazon might not exist in 30 years. So businesses over a long enough time horizon, all businesses die. Real estate is very different. Now, over a long enough time horizon, all buildings will decay to nothing, right? And this is one of the challenges with real estate is actually the depreciation of the asset or the property that sits on top of the land, right? There's two components to it, obviously. So you have this, over like, what's the kind of replacement timeline for a property on the land? That's one thing to consider. But you still fundamentally own the land. You can build a new property and all of that kind of stuff. And construction costs get nominally cheaper in kind of real terms, all of that kind of stuff. But the utility value and the continued demand for real estate means that it's a lot harder to fuck it up, basically, right? So it is a lot more true that over a long enough time horizon, real estate will smooth out all of its sins. But that doesn't mean that you don't get suboptimal returns if you get the timing wrong. Now, a great example of this is Gladstone, for example. I think it was back in 2011, and I could potentially pull up a chart on Gladstone actually, but I'll get distracted. So yeah, do you want to just look up Gladstone? Because so Gladstone is a really great example where a lot of people got into the market when it was already too late, and then the market went down, and so people had like 10 or 12 years of negative returns on their asset, all because they didn't get in at the right time. Now, interestingly, and just to give away a little bit of the secret sauce, I think we are actually buying in Gladstone at the moment. But this is a classic example of how getting the timing wrong can give you suboptimal returns. The aim of the game here, of course, is how do you become more successful as an investor? How do you maximize your return on capital? How do you allocate your capital in the smartest ways at the right time?
Yeah, awesome.
How you going with the chart?
I'm opening Pathfinder.
Okay, cool. If it's going to take a little bit of time to get there, don't worry about it. Let's just keep moving.
No, I've got it. It was just like because Gladstone's an LGA and we have the reports for the suburb, so it's just loading.
Oh yeah. Okay. Maybe just pick
like I've got Gladstone Central.
Gladstone Central would not be a good representation because it's a commercial district. Try King Cora.
Okay, go back. King Cora.
But one of the most important things is like how to identify these points in time, right? So how do you think about mean reversion as well, and how do you think about selling into strength versus selling into weakness? Let's get the chart up around King Cora. I hope it's a good example because maybe it's not a good example.
All right, we want the forecast charts.
No, I just want the key indicators chart.
Key indicators. Yep. Yeah. Okay, let's share my screen. okay. It just
Okay, let's skip
crashed.
it. Let's
Yeah.
keep moving on. Yeah, let's move on.
Let's move on.
So let's move on. Let's move on. We'll share some more stuff later.
Yeah.
So now one of the most important things though to consider in this framework is what is your personal hurdle rate? Because the question that you got to ask yourself when you're investing is how high is up? Now everyone wants to make money when they're investing, but how much money? And how can you rationalize when to be okay with a certain return or not? Now, everyone needs to decide their own personal hurdle rate. For me and for us, our personal hurdle rate is a minimum of 20% a year compounding. Now, why is it 20% a year compounding?
Before you go there, what do you mean by hurdle rate?
Yeah, so that is the rate of return that I want our money to compound at, right? So it's the growth rate that I seek to beat, right? It's the kind of minimum acceptable threshold of compounding growth on capital that we can have, right? The minimum return per annum that I would want to see.
Oh yeah, yeah.
Now, the reason it's called a hurdle rate is because like that's the rate that we need to try and jump over, right? So if we get less than 20% compounding or less than 20% annual returns on our capital, then we're not meeting the hurdle rate. So we're not meeting the kind of benchmark of performance that we seek in our own personal portfolio. Now, of course, you want it to be high, right? So, but you don't want to just also chase the highest possible returns. You asked me the other day, you asked me an interesting question. You said, hey, if how would you make $10 million by the end of the year? If I said to you, if I gave you a chance to make $10 million by the end of the year, I'm like, well, what are the parameters, yada, yada, yada. And it's like, how much risk are you prepared to take? Because you can push way out on the risk curve, but then your risk adjusted returns are going to be different as well. Right. And so you really need to take that into consideration. And sometimes it's not about trying to seek the fastest, highest absolute gains. It's about how do you get an appropriately risk adjusted gain such that you're not going beyond your risk profile and you're beating your personal hurdle rate. So our personal hurdle rate is 20%. Now, our target hurdle rate is 40%, right? So the minimum is 20, the target is 40, and I think above 40 is good, like really good, right? So I'm happy with that. That is not super aggressive. And a lot of people are going to be sitting there going, well, where the hell are you getting these kind of returns? And we'll do a whole episode on how to get those kind of hurdle rates. The reason it's 20%, though, is the way that I think about it is there's 10% of money debasement. Then you've got to consider things like tax. Then you've got to consider, if you're in a depending on your jurisdiction. Then you've also got to consider things like your risk weighting, right? So the more risk you seek, the more allowance you have to have for a return on that. Because if you have something with a 0% risk rate that returns 20%, or if you've got something that's got a 100% risk rate that returns 20%, those two assets are not equal, right? One on a risk adjusted basis is far, far superior to the other. So thinking about that, you have to have a risk premium that you attach to that. And then you want to make sure that you're growing and not just treading water. So I kind of like, you'll often hear me say that sort of the minimum hurdle rate should be roughly about 14%. That accounts 15%. That accounts for taxes and risk premiums. For me, it's 20% because I don't want to tread water. I want to get ahead, right? So that's where that sits. Now, if you can understand that, then you can make better decisions around when to exit. Rather than thinking about the most absolute returns, you can get comfortable with with the returns you have. Now, Gabby, is it easy to share screen? Because I actually have a chart that I'd like to show and show a real world example of this exact thing in practice.
Down to present and share screen. And then
cool. Let's take a look at this chart here.
Okay, cool.
Okay,
nice.
So this chart here is MicroStrategy. Now, if you joined us on our last episode, I think we spoke about MicroStrategy. I'm not here to give you a whole kind of breakdown on MicroStrategy, the asset. What I want to talk to you about is a personal experience that we had that highlights this exact point that I'm making about getting comfortable with your hurdle rates. Now, as you see here, when you look at this chart, MicroStrategy on the 21st of November peaked at about $543 roughly up here. Now, I remember that very specific date because I saw how much it had skyrocketed up. And I actually said we own some MicroStrategy. And I said to Gabby, hey, Gabby, I think we should sell a whole bunch of our MicroStrategy because this looks like it is it looks like it's a blow off top. And then for whatever reason, I said, you know what, let me sleep on it. Let me sleep on it for just overnight. And by the time I woke up in the morning, it had gone down to here. So it had gone down here, right? So instantly it had fallen back down. Now, if we look at from peak of 543 down to where it is today, let me just use a little tool here. We can see that it has dropped by approximately 42% from its high. So you could sit there and say, oh my God, that's lost 42% of its value since its peak. That sucks. How shit. We missed the top. That's bad. Oh my God. Woe is me. We've lost all this money, which is just not true. Because if we look at it from the other perspective, we actually started buying MicroStrategy early in 2024. Our average entry price was about $130. And if we take a look at this and just go, okay, well, what is it from here to there? You'll see that it's up 137%, right? So it's up 137% in less than a year. So do I want to cry about the fact that it came down, that we missed something like 42%? Or can we be satisfied that we've made 137%? Which one of those two things would we be more satisfied about? Now, if our hurdle rate is 20 to 40% in 12 months, we have tripled the 40% hurdle rate. So I can sit there and say, oh, well, it would have been nice. Would have been nice to kind of catch that top, but I don't have to sit here and cry about the fact that I missed it and that it's come off a little bit. And I think this is really, really important. So just quickly, I think this is really, really important because as a general premise, I will always say it's better to be 5 minutes early than a minute too late. So you typically want to sell into strength. You typically want to sell when you can see that a market is, or an asset is starting to peak and before it goes past the top. But then if it goes past the top, a lot of people freak out and go, oh my God, I'm going to have a breakdown because I've missed something. Where in actuality, if you can park your emotions and put them to the side, you may actually find that you're still in good stead and it doesn't really matter. So you were going to say something?
No, that's actually what I was just thinking. It's because a lot of people particularly in real estate, we think about timing being so critical. Obviously timing getting in, but then also timing getting out. If you are going to sell, obviously it is preferable from a like maximize returns to time the top, but also with this different mindset, you don't necessarily have to get super stressed out about timing that exact, like it might be a couple of weeks, it might be a couple of days, that very top point of that curve. Whereas if you can realize like, where is the line, where is my hurdle rate across this growth chart, and know against that plot where you got in, and then you're measuring it from that point, not necessarily from, did I get that exact day at the very top of the peak?
Yeah, exactly right. Yeah. Exactly right. So, so understanding your hurdle rate is really, really important. It's going to help you to rationalize things and stay calm even when prices move. Right now, one of the great examples in real estate is price discovery is very difficult in highly illiquid assets and highly illiquid markets. So it's actually quite common to say, get a bank valuation for say, let's say $700,000 on a property. And you go, great, I want to sell that property for $700,000. And then you go and speak to a real estate agent to get an appraisal. And the real estate agent says, look, it'll sell for between $630 and $650. Now, what do you do in that scenario? Do you say, oh my God, the bank valuation was $700,000 and now I can only sell it for $630? Oh, well, how much did you buy the property for? How long have you held it? Maybe it's maybe you bought it for $400,000 2 years ago and it's worth $630. Okay, cool. Price discovery is very difficult in a highly illiquid market. And so being able to rationalize our emotions around these returns is really, really, really important. So this is why I kind of want to like bang on about this kind of idea, this idea. And just to kind of like reiterate the point, you can hold assets for the long term, particularly in real estate. And if you've got a good quality asset and a good quality location, holding it through multiple cycles, you'll get multiple compound effects all working on top of each other over time, and that is good. But also, one of the things you should be considering is if I'm at the peak of a certain market at a certain point, am I better to stay through to another cycle and wait, or should I, in fact, think about repurposing and repositioning my capital, redeploying my capital in another way? Now, there's a couple of considerations around this, particularly in real estate, is, what is your borrowing capacity? What's your ability to support further debt? What is all of this kind of stuff? But kind of thinking through this idea of rotating capital versus holding through multiple cycles in any asset is going to be critical. Now, real estate is typically more cyclical than other stuff. So businesses and equities and stuff behave differently to real estate, right? So businesses can boom and then just completely shit the bed and die. And it could be, again, yeah, there's a business cycle and there's some other stuff in there as well, but businesses can just die. So it is fundamentally different, and there's a significantly different risk profile with equities than real estate. But fundamentally, you could just potentially just hold through multiple cycles. In fact, why don't I show that diagram I've got around market cycles?
Market cycles? I can do that.
Yeah.
Yep.
You sure? Okay.
Yeah, the deck.
The market cycle timing slides.
Yep. 1 second.
I've it's easy for me. I've got multiple screens. You've only got one screen,
Voila.
right? Okay, cool. Yeah, so a lot of people think that the property markets move in cycles, and they think it goes round and round and round like a clock, but it doesn't really go round and round and round like a clock. Just go to the next slide. So it actually goes in more, typically most suburbs go in more of a stair-step pattern. Now, if you imagine that the diagonal line, the bold line that goes up into the right at a 45-degree angle, if that's basically your average rate of return of, let's say, 8.25% compounding, what you tend to see is suburbs will be below the average, and then they'll shoot above it. They'll have a spike, they'll have a growth spurt, then they'll be above the average, and then they'll go flatter and they'll revert to the mean, then they'll pass through, and then they'll boom above it. So we sort of have this like cyclical wave that kind of goes, oscillates above and below the mean. There's always some degree of mean reversion. So when it's below the mean, it'll mean revert up and then go past it. It'll shoot past it because there'll be market momentum. And then the market momentum will reach its peak, and then it'll kind of flatline and smooth out. And then it'll revert back to the mean over time, and then go beyond that because it's been soft for ages. So there's less market strength, and then it'll become undervalued, and people recognize it's undervalued, and then it'll kind of shoot above it again. And so thinking through this, now, if you were, let's just say if you go to the intersection where the gray line, just go up where the top of the gray curve is. Yeah, there. So let's say you're right at that point there, and you've got a decision to make. Like, do you sit there and say, okay, I'm going to hold this through to the next cycle, or do you say, hey, I'm currently in a market which is, a couple of standard deviations above the mean or the median, is now a great opportunity to capitalize and redeploy capital. Now, what you want to try and do, if you go to the next slide, what you want to try and do is you want to try and buy when locations are below the mean, when they've mean reverted beyond below the kind of average growth rate over time. Now, that's kind of interesting and kind of tricky to work out, but it's right. How do you buy when the markets are soft? How do you ride them through the strength? And then how do you trade them through? Now, I will say you don't have to do this. A lot of people are just like, I don't want to trade properties. I want to just buy and hold forever. But most people are going to be capital and borrowing capacity limited. And so if you do that, you're going to get stuck at a certain number of properties. Now, the difference is if you've got a tremendously high income, let's say you're a business owner and you're earning, I don't know, let's say you've got a personal income of $1 million a year, and you've got tons of borrowing capacity and tons of capital and stuff. You might just say, look, I don't want to trade assets. Just like, let's just keep riding them out. That's fine. But for 99% of people, you're going to find a threshold that means you have a limitation on your borrowing capacity moving forward. And so thinking about rotating capital in these markets is critical to maximizing your return on invested capital over time.
Awesome. 2 questions.
Mm-hmm.
So first would be, how do we know, how do people that are watching this, how do they know where they are along this curve? Like, how do they know if they're here or they're here or they're here? First question. And then the second question is, just if we identify that we're here, how do we know if that's like, is that always I should sell now? What else comes into that decision? So 2 big questions.
Yeah. So there's two big. I'll answer the second question first, right? So what do you do? Let's say you've identified, hey, the market is close. The market so firstly, no one's got a crystal ball, right? So no one actually knows what is going to happen in the future. We've got some amazing technology, but I'll even put it that can forecast the market, but I'll even put the caveat that we don't, it's not fact. Everything's theory until it's fact. And so what you need to do is you need to form an opinion of whether or not you think the market is at a high point or approaching what could be at the top. Also, just take a point of view of how much returns have you made in that period of time. Are those returns above average over a shorter period of time? In which case, is it more likely to revert to the mean or not? And then the question about what to do about it is going to depend on your personal circumstances. So, and we've got some examples of client portfolios that we can show in a minute, and it might be too quick to jump to them. But for example, like we've spoken to clients who have got properties that are in markets where it's like, okay, these markets are ostensibly quite close to their top. If you wanted to sell, now might be a good time, but they've got no borrowing capacity. They effectively became financially free and now don't work and basically can't get loans. So they could sell the properties, unlock the capital, but then wouldn't be able to get more loans to go and buy more properties. And so for them, it's a case of like, well, there's not a better solution of what to do with the capital. So let's just leave it and let's just play the long game. That's fine. That's all good. Because the rents on the properties are going up over time. So their nominal yield is increasing over time. And so they're like, cool, play the long game. There are other clients that I've spoken to where their properties have been in locations which are getting closer to a peak, and they've said, sell them all, let's reposition the capital, because they're going to unlock, say, $700,000 of borrowing capacity by selling down those assets and releasing those loans. So they'll get their borrowing capacity back, and then they can go redeploy the capital with that newfound borrowing capacity to go buy more properties.
Yeah, because it's obviously there's much more to it when you take a portfolio approach, right? It's not just about looking at the individual asset and where it is timed. It's about how is this asset interacting with the rest of my portfolio? How does it interact with my financial situation and my ability to borrow more? All of these different things factor in together. So it's like, I think with all of this, it's starting with info gathering, right? We need to collect as much information of our current reality as possible, which includes trying to identify where each of these markets, where each of my properties are at.
Yeah.
And then also like getting an updated borrowing capacity assessment, figuring out all of these pieces so that you have all of the information together. And then you can sit with it and go, okay, I am constrained here. Like I have no borrowing capacity, but I haven't quite reached my financial goals and I'm ready to redeploy some capital. Like I'm happy to maybe sell down or refinance or something. I don't just want to hold and wait it out. And you can only really do that when you've collected all the right information, right?
Yeah, exactly. That's 100% correct, right? And everyone's situation is going to be very, very, very different. So this is why I think it's important to, the thing that I want to emphasize in this episode is how to think about some of these things so that everyone can start to make informed decisions, because there is no hard and fast rule. There's just making informed, intelligent decisions. So I'm going to share another example.
Cool.
Share screen, suburb one, share. If I go into slideshow mode, is that what I do? Oh yeah, look at that.
Oh yeah.
Oh yeah. Look at this. So this is an example of a real suburb that we have bought properties in for clients, right? So we were buying properties in here, let's say, in the sort of 2019 through 2021 period. I'm not going to name the suburb because we have clients in this suburb right now. Now, if you just take a look at this suburb here, in August 31st, 2020, it was the median sales price was $350,000. If we fast forward to today, I know that says November 2024, but the data is actually January 2025 ending out here. It's about $650,000 or close to. So that's almost doubling in 4.5 years. So that's pretty tremendous growth. That is pretty tremendous growth. So then you've got to think to yourself, okay, so what is the likelihood, what is the probability that this growth will continue at that rate on a go-forward basis? Or what is more likely to happen? Now, that is one question to ask. Now, one of the things that we can see in here is that even though demand to supply is quite high still, there is still a lot of demand in the suburb, we can see that it's starting to trend off. Now, just because there is a trend down in demand that's not cataclysmic, because you can see here that demand trended down from this point here to this point here. Yet if I go back, show me where that is in the prices, you can't see it. It doesn't matter. So sometimes demand necessarily oscillates in any given suburb. So looking at a demand to supply ratio is not the be all and end all, but it is one data point that you should consider. Now, what you sort of want to understand is what is the organic demand in a location versus the exogenous demand. Now, when I say exogenous demand, I mean demand coming from people who aren't living in that suburb. So investors that are just buying in it, like external capital being deployed into that market that is non-organic, organic being local. So we can sort of start to see here that this location has had rocket ship growth over, say, 4.5 years. It's gone from 350 to 650 in 4.5 years. Demand appears like it may be starting to soften. Now, for those of you who can see this, there is a gray band here. There's a dotted line, and then there's a light gray band. I know it's very light, but it is there. Generally, when we see demand to supply above this line, it means prices go up. So even though this is trending down, it is still above. It is still in a zone where we expect prices to continue to rise. When it's within the gray band, we expect prices to broadly stay flat. And when it's below the gray band, we expect that prices broadly will decline. So it's still in a zone where even though demand is starting to soften, it doesn't actually mean that prices are necessarily going to go down. But what we can start to see is, well, where might this go? Okay, so we've had explosive growth. Demand is starting to soften. If that continues to trend down, is that likely to make it harder to sell a property? Is that likely to decrease buying pressure in that suburb? And then if we zoom out, this is the exact same suburb, just zoomed out to 40 years. These are 10-year charts here. So if we look at this over a 40-year time horizon, we can start to see a little bit of the history of how this suburb has behaved. So what I was showing you in the 10-year was roughly from here up. And you can see that's an exceptionally strong leg up. But we've also seen this kind of thing happen before here. Now, what tends to happen, and again, this is representative of what we were just showing with the previous diagram, where the market tends to go in a step, kind of like a staircase fashion. It has a leg up, it drifts sideways, and it has a leg up. Now, different suburbs have different kind of dynamic shapes to them. This is pretty common, but there are different. So often capital city suburbs have a kind of like a different dynamic market shape, but they still broadly follow the same idea. So what tends to happen is the legs are different lengths and different shapes, but broadly they leg up, they drift sideways or down, they leg up, they drift sideways or down. Now, what you can actually see here is that has happened before, but it's because it's exponential. There's actually a big step up here. You just can't see it as much because the prices are smaller, right? Because it's an exponential chart. So this goes back down to about $20,000. Now, what I did is I superimposed broadly an 8.25% compound annual growth rate on this suburb, so that we can kind of see how this specific suburb oscillates above and below the average growth over time. So I kind of took the inferred price in 1986, applied an 8.25% compound annual growth rate, put a trend line on there, and this is kind of, it's not exactly perfect, it was pretty close, right? So based on that, this suburb, the average price should be approximately about $450,000. Now we can see it's up around $650,000. Okay, awesome. So if we just follow this trend and said this was the average trend, like in that the market cycle timing diagram, that the diagonal line up and to the right, is this trending under, over, under, over, under, over? So what's likely to happen over time? So when you find yourself in a position like this, hopefully you've entered in at a really good time and hopefully you've made some money. Now, maybe you entered here and maybe you've only taken up this part of the leg, but maybe that is still okay, because maybe you've still made 100% return on invested capital. And maybe it's still okay for you to sell sooner than you thought that you were going to, because you're still going to beat your personal hurdle rate. And this is why the personal hurdle rate is really, really important. It's not about like, oh, but I wish I got in earlier. Yeah, but you didn't, right? So it doesn't really matter like what you could have done. What matters is your return above your hurdle rate, your expectation, and can you redeploy capital in a very intelligent way? And I'll just say another point on that: the most successful investor in history, aside from Jim Simons, so one of the most successful investors in history, Stanley Druckenmiller. He is famous for getting a 40% return on invested 40% compound annual growth rate, or 40% return every year for like 35 years. So if you can beat 40%, you're in one of the top. You're like one of the best investors on the planet. Now, it's actually not that hard to do with real estate. So you could have bought here on this and still just take this leg up and then go, well, okay, so maybe demand is starting to soften. We can start to see this here. So maybe I'm going to sell this property. Maybe I've only owned it for 12 months or 13 months. And you can sit there and say, well, is that good or bad or otherwise? But maybe you've made a 60, 70, 80, 100, 120, 150% return on invested capital, in which case, great, your hurdle rate's intact. Who cares? Move on, redeploy the capital. Does that make sense?
Does. Yeah. There's obviously like this, there's so much to all of this. Obviously, like we're saying, looking at it at the portfolio basis, but then all of these different metrics. We've actually got a question just come in. We've got a couple of questions, but this one's relevant to what we're talking about from David. Let me just pull it up on here. What are the key indicators or metrics Dashdot uses to identify when is the right time to sell a property within a portfolio? Is this a service currently available with Dashdot?
So, yeah, it's a really good question. Now, I'm going to break that apart a little bit because there's nuance in there. What are the key indicators or metrics that Dashdot uses to identify when is the right time to sell a property within a portfolio? So we would look first at the suburb and say, is this suburb in a position where it might make sense that if you own a property in that suburb to consider selling? That's where we would start, right? Because that's the macro view. It's kind of like, okay, how much has this suburb grown? Where is it in its cycle? What's the probability that we're going to continue to see growth in this suburb over the next 3, 6, 12 months? How do we sort of start to form a view on that? That's the first thing. The next thing is very individualistic because it's going to really depend on the personal circumstances of the individual. Because as I mentioned earlier, we've got a couple of clients, and I actually spoke to them the other day, and they have like 6 properties they bought with Dashdot. They basically became financially independent, and so they don't really need to work anymore. They kind of work part-time, and but their borrowing capacity is like crashed, right? Because they don't really have to work anymore. Now there are three of their 6, which is awesome, by the way, and they're not even 30; they're in their 20s, right? Which is crazy.
Yeah.
Now their set of circumstances is that they basically have no borrowing capacity, so they then look at their portfolio and go, okay, well, it might be the right time to sell in these suburbs, but if we sold those properties, what would we do with the capital? And is there a better place for us to position the capital or not? Or are we actually just better off to hold through those suburbs? So that becomes a very personal decision. And so we do currently, we have started a service that actually does portfolio reviews. We have started to launch that. We are focusing primarily on our clients. Gabby, are we going to drop a link in the Who's He What's It for people to be able to apply to do that if they want?
In the Who's He What's It, there will be a link in the Who's He What's It after we finish this. Yeah, to sign up, and you can give some context.
Yeah. So I'll give a little bit of context, right? So yes, we have started to offer a service where we do portfolio reviews and provide insights on buy, hold, sell, refinance, all that kind of stuff. The key thing here is we're not going to tell you what to do. We're not going to say, hey, David, you should go sell that property. You need to decide whether or not you want to sell that property based on getting good quality information and being an informed and intelligent investor. We're going to guide you through that process, try to give you all the information you need if you do. Now, here's the problem. Yes, you can sign up. Sorry, just quickly. Yes, we have started to offer this as a service, but it's extremely limited. We've got very limited capacity. It's a whole new team we've built out at Dashdot, and we're focusing on existing clients and working through that. But we also understand this is a really important service for people as well. And so we are going to give you the opportunity to apply for free. We'll do portfolio reviews for free. The only request that we've got is if you submit your information, bear with us, because depending on how much demand we get for it, it might take us a bit of time to get to you. But I will also show you how to start to form an opinion yourself. But you wanted to add something in there, Gabby?
Oh, no, I just wanted to say, David, I do recognize you as an existing client. So I will make a note for the team to have a look at your portfolio and reach out to you in that sense. But yeah, like Goose said, we want to be able to start giving people the opportunity to submit their information, even if they're not a client.
Yeah.
It is genuinely really limited because we're still just working things out. But if you submit your info in the link in the show notes or the YouTube description, the team will reach out to you. It might take a couple of weeks or something, but it'll get the ball rolling.
Yeah, we'll get there. Now, going back to the indicators, the metrics. So some of the stuff I'm not going to talk publicly about on YouTube, but we look at things like how much has the suburb grown. Where do we see demand coming from? How does that show up in a variety of different metrics that we use? And I'll actually, why don't we actually take a little wander through? Why don't I give you guys?
You love a wander?
let's go for a little wander. Let's go through for a little wander through Property Pathfinder. Just give me
Yep.
one. No, I'll share my screen
Yeah.
because I really struggle to not be in control whilst.
No, I figured that you went for the screen share yourself. Yeah, NQ. Hi NQ. I don't know your full name again, but yes, the portfolio reviews are free for existing clients. So it's part of our ongoing service as your portfolio growth partners, is that we will just continue to monitor and give you some insights from our side. Totally free. All right. You are sharing your screen.
I am sharing my screen. Okay, so this is Property Pathfinder, and you can what?
No, it's just you being in control. You're like, yes, let's go.
Yeah. I struggle to like, talk with my hands tied behind my back. So you can sign up to Property Pathfinder for free. If you just go to propertypathfinder.io, you will be able to sign up to Property Pathfinder for free if you haven't already. If you're an existing client, you probably already have a personalized property portfolio growth plan. If you want to create one yourself, you can create it here on the platform. What I would say is wait a couple of weeks because we are doing some major updates to the portfolio growth plans. So if you really want to get the juice out of it, I'd say wait a couple of weeks. What I want to show you here is I want to show you. How do I clear the filters? I want to show you REMI, Real Estate Market Intelligence, right? We actually built this tool so that everyone can analyze suburbs themselves and start to get a better understanding of it. So what I want to walk you through right now is I'm going to show you an example of a suburb that Gabby and I bought a property in where we missed the top. I think that's always really, really interesting. So using Property Pathfinder and go to REMI, you can, firstly, let me go back actually. You can get a quick snapshot of the suburb. You can have a look at the growth potential, median sales price forecast for 15 months, and I'll show you that in a second. Cash flow score, estimated rental yields, estimated net rental yields, gross rental yields, median rental growth forecast, affordability score, socioeconomic score. We've had to develop a lot of this stuff ourselves. It's pretty wild and proprietary stuff, and you can get access to it for free. Just go to propertypathfinder.io and sign up and you can check it out. Now, we've pretty much got almost every suburb in Australia in here as well. Now, once you find a suburb you want, click on it. And so you could do this. And the reason I'm showing you this is if you're sitting here at home and going, oh, how do I maybe try and work out whether my property is in a location where I want to sell? This is how you can start to do it. So go into Property Pathfinder and then go to the suburb and you'll come up with a page like this. This will give you a good summary. Now, this is all generated by AI, and a spider graph of growth, cash flow, affordability, and socioeconomic score. There's some information about each of these scores. And you can see that the socioeconomic score takes into consideration things like demographics, crime rates, unemployment, all this kind of stuff. Now, the reason I point this out is, David, you were asking about key indicators that we use. All of this stuff that's in here, so socioeconomic stuff, affordability stuff, these help us form a view. So there's hundreds of things that we look at either directly or indirectly through indicators that we've developed that help us to form a view whether or not a suburb is good, bad, or otherwise. You've also got information here around population, all that kind of stuff, including population forecasts, which is pretty wild because this is one of the only places you can get it. Dwelling information, et cetera, et cetera, et cetera. Right now, the interesting stuff is in here, in my opinion, which is the key indicators. If you go to the key indicators panel, you can go down here and you can start to look at things like supply and demand indicators. And you can see in Nor Lane, in this suburb here, in 2022, demand was high, 5.38, and then it crashed down to 2.153. So that was good, and that was not so good. But now it's spiked back up. So if we actually have a look at the 2-year trend line, you can see that the 2-year trend line is actually steeply on the up here, which is very, very interesting. Now, I like to point to this because this gives us a sense of demand. Now, this is not the be-all and end-all. You have to overlay this with other things like local intelligence, on-the-ground intelligence. You have to overlay this thing with things like socioeconomic profile, demand, jobs, growth, all of this kind of stuff. But this is a good kind of general guide of where the market is kind of going in terms of a demand metric. So if we look at this, it's trending up, which is good. Median sales price. Now, this is interesting because we bought a property here. Let me just go out to 15 years. We bought a property in this suburb right around here. No, right around here, which was actually, and you can see that this suburb follows a similar stair-step pattern. So it goes, drifts across, legs up, drifts across, legs up, drifts across. Now, we didn't really understand as much about data at the time. We bought a property which was under market value and a really cracking deal. It turned out to be an amazing, one of the best purchases we've made, even though we made it at the top of a cycle. So this is really interesting. So we bought inadvertently at the top of a cycle because we were like, oh, this suburb, it's screaming. And we made kind of junior mistakes where we were like, look how much it's grown. We should buy there. Actually, we probably should have said, look how much it's grown. Should we consider buying somewhere else? Now, because we bought significantly under market value, we were able to capitalize and make a whole bunch, make that a really good economic decision. But that's not usually the case. So we kind of bought at the wrong time, but we still bought well and made money off that property. Then it drifted and did nothing and actually went down in value. You can see here it went from, sort of 355. We bought a property there for about 300,000. Drifted down. We lost value, and then it rocketed up again up to here in 2022. Now, in 2022, late 2022, 2023, we had a bank valuation on the property at like 600 and something. And we said, oh, that's great. And then we just forgot about it and did nothing. And then we went to have a look at it recently and it had dropped down and the valuation we got, or the appraisal we got, was 440,000. So we actually missed the top and it drifted down here. Now, in this exact circumstance, we said, okay, well, what are we going to do? Where do we think the suburb is going to go? So we're actually holding that property through for another cycle. Now, we missed the top here and it drifted down. But you can see this kind of patterns played out. Now, let me show you another suburb. Actually, let me just quickly show you one more feature on here that you can go play around with yourself. And this is all about starting to triangulate and form opinions. Now, we have built a price and rent forecasting model. I'm going to bring this back down to the 5-year. This price and rent forecasting model is insane. And we can send you you can read information about it on the platform as well. But we can see here that the price and rent forecasting model is indicating that prices may pick up. And I actually believe that to be true too, because we can broadly see that Melbourne is at the bottom of a cycle and is about to start to tick upwards. And Norlane, being a suburb of Geelong, is going to follow a similar trend path and similar trend pattern. So we can form an opinion that's like, okay, so we're now at a low point here in the cycle. Is it more likely that it's going to go up or more likely that it's going to go down? So we have formed an opinion that on this specific asset, we'll hold it and continue through to another cycle. So that's cool. So that's how you kind of think about that. Now I'm going to show you another suburb, actually, that we also bought a property in and where we sold one. And I'm going to show you the differences between these. So again, you can access all of this on Property Pathfinder yourself. So the suburb was Goodna. We bought a property here in 2019. And again, let's take a little look at this. And again, you can access all of this yourself. So you can go on here. If you're sitting at home and you're thinking about your PPR, because I saw there was a question in the chat around a PPR, which I actually haven't read the question properly, but I just saw there was one about PPR. You might be sitting there going, well, should I sell my home? How should I think about this? Is it the right time to sell in my suburb for my home or anything? You can go on Property Pathfinder and you can get the information you need to start to make an informed decision around where you are at in the cycle.
While this is loading, I'm just thinking through like the data sources, not to go fully into this, but I think this is actually a really unique thing in what we've done here, because we pay a lot of money for all of the private data sources that we pay for from different providers, but they're the best in the industry, that we pull all of that into one place. And so it's all in one place rather than, firstly, it's not just what is publicly available on realestate.com or even CoreLogic, or it's the private, the deeper data. And so we pay for that and we put it into here, and it's actually for free, which is kind of crazy. But you need to know how to read it.
But this is but this is a lot more than data aggregation, because what we've actually had to build is we aggregate many sources of data. But then we've actually had to build our own indicators over the top so you can interpret it. It's not just data aggregation, it's data interpretation and insights. So I just want to quickly, going back to these kind of points that we've been making around like market cycle timing, which is kind of, I want you to think back to a little bit earlier in the stream where we showed the original diagram around market cycle timing, how it looked like a staircase, right? And all of these kind of examples that we've used, because this is more of that proof. So if we go here, now this is the suburb is good. Now we bought a property here in 2019, right? When it was, we must have bought around
June-ish, I think.
March, April, June. We bought somewhere around here. We bought it for about 280 grand, right? Now you can see the market bottom here is around 285,000. And the market here is now like 605, 645. So we actually sold a property in this suburb. We bought it for 280 and we sold it for $630,000. Now, what's interesting about this is we have again followed a staircase pattern, leg up, drift, leg up, drift, leg up. Now you notice that this drift is a lot shorter, but you can also look at this and you can go, okay, from 20, you could take this as one big leg up. And if we had the 40-year data in here, we'd actually see that this legs down for a really long way as well. So what you could reasonably ask yourself is, if I own a property in a suburb that's gone from 285,000 to 645,000 over the course of 5 years, what is the probability that that is going to continue to grow in that way? And what would I use to support that thesis? Now, it's very important. Now, this suburb may continue to grow. So this isn't just if it's gone up, you should sell. You have to take the time to really understand, has the thesis changed? Is something different about this? Is it overheated? Or actually, is it just growing into the demand that exists? Has something fundamentally shifted that this could go to $1 million? You need to be able to form that opinion. Now, I'll quickly show you a couple of things you can do on that as well. Because if we have a look at the price and rent forecasts, here is where it gets really interesting. Now, what we can see here is that potentially, right? Because again, this is not everything's theory until it's fact, and this is not a crystal ball, but potentially we can see that Goodna may start to reach a cycle top around here. Now, is it just going to drift sideways for a short period of time and leg up again? Maybe. So you need to start to kind of think about that and go, okay, what's the probability of that happening? How do I think about this? Do I want to continue to ride my capital in this market? Or should I look for other opportunities where I feel there's a higher probability that I'm going to be able to deploy my capital and achieve significant gains? Now, one final thing before I kind of shut up and give you a bit of space to talk Gabby as well, is looking at the projects. You can look in here and you can start to get an idea of what is going to drive growth, demand, jobs, all of this kind of stuff. Because fundamentally, location selection in real estate comes down to 3 core factors: jobs, lifestyle, and affordability. People have to have a place to work and have to have an opportunity to generate income. So there must be an economic incentive. There must be good relative local affordability. So if the average wage is high, then you can have higher priced houses and it can still be relatively locally affordable. And it also must be livable. So people must want to be there. So you've got to have an apex of these 3 things happening. So you can look through here and say, okay, well, based on the projects that are coming up and the various stages that they're at, when they're expected to start and finish, do I think that this is going to perpetuate more demand or less demand, or is it going to kind of, how is it going to shape up? Now, internally, we've put a lot of this stuff into our assessment metrics, but you can start to use this tool yourself. So I'd love to know in the chat if you think this is useful, if you have any questions around this. But I wanted to just re-highlight that you can start to use this to form your own opinion about where you're at in the cycle for your own properties, and start to make that opinion. And it's available for free. So just go to propertypathfinder.io, or in fact, in the description in the description below, there's a link, and you should be able to get to that and sign up yourself and get access to that now. And it's free.
Cool. It's free. It's free.
And it's free.
It's so funny because it's like we're really proud of it. I think it's an ongoing multi-year project, this tool.
Yeah.
And I think it's pretty wild that we've decided to just put it out for free. Again, because hopefully if you listen to the show, you pick up that like Goose and I really just care about helping people. And so if we have stuff that's going to be able to help people make decisions further than the people that we can reach in terms of like becoming clients of ours, then this is a way that we can do that. And so making it free is actually going to be the easiest way for it to reach the most amount of people. So one question I had was about, I don't know if you wanted to pull up the MSP chart again, but how can we factor in what you were talking about earlier in terms of our individual hurdle rate? So like the 20%, trying to understand, okay, if I'm looking at this MSP chart, the growth chart, how do I actually know where it is above or below the line? Or are we just making a judgment based on
So
where the
you can
stairs
make a judgment,
steps?
right? So for example, if you assume broadly that the average suburb growth rate in Australia is 8.25%. Now you can calculate that on a suburb basis, right? You can say actually what is the compound annual growth rate of that specific suburb? But broadly, let's just say it's 8.25%. Then you could ask yourself, okay, how much has this suburb grown over the last 3 to 5 years? Is that more than 8.25%? Let's say it's, just for the point of the discussion, let's say that it's 12% compound annual growth rate for the last 4 years or 5 years, right? Then the question to ask yourself would be, what is the probability that it's going to continue to be above 8.25% moving forward? Or is it more likely that it would revert to the mean, in which case it would actually go below 8.25% at some point in the future, such that the average over, let's say, a 10-year period, and tenure is just every suburb's different. So none of this is like, there's no golden rules here. But let's just say the average over a 10-year period might be 8.25%. So if it's outperformed for the first 5, is it more or less likely that it's going to underperform for the next 5, right? So that's the sort of way to think about it, is to look at those dynamics. Now that is different from the personal hurdle rate, right? So looking at this and going, okay, where is this? What's the probability this is going to continue to grow? And again, things change. Things change in suburbs, right? So this is not just for suburbs. This is for all assets that you invest in. The question you need to ask yourself is, has the thesis changed? Right? There's actually a couple of questions, right? So, has the thesis changed? Is there anything different today about how you think about that asset or that location or that suburb versus when you invested? Has anything changed? So, for example, a great example of this is Warren Buffett was heavily invested in airlines. His thesis changed. He divested massively from airlines. He was like, no, okay, this doesn't make sense anymore. So has the thesis changed? It's very, very, very important. Has something changed about the location? Now, perhaps in a location context, perhaps there was a major project that has been suddenly cancelled.
Mm-hmm.
That's a good reason to go. Say again?
Which happens.
Which happens. Yeah.
Yep.
That's a good reason to say, okay, well, fundamentally, does that change my thesis on this suburb? Or has some macroeconomic situation shifted such that the thesis that was the reason we got into this location, is that still as strong as it once was? Now, just because something has gone up a lot. So I'll actually use a different example. So there's another company that we're invested in, and it's gone up by 500% in the last 12 months. And it's very easy to sit there and say, oh my God, I can't, come on, 500% in 12 months. That you can't. But the reason you've got to look at it and go, okay, fundamentally, does it make sense? Does it still make sense? Now, if revenues have grown and cash flows have grown and debt has gone down and they've increased their number of contracts and there's enough things to support the growth, there's no reason that wouldn't continue necessarily. And so you've got to make form an opinion around, has the thesis changed? A great example of that is Tesla. The thesis might change, right? In fact, so once upon a time, the thesis was they're a great electric car company. Now the thesis is, in fact, that they're a great AI and robotics company. So their thesis has changed, but in fact, that might strengthen the case or weaken the case. So you might have a company, for example,
Okay, Goose, I think something's happened with your audio.
Can you hear me?
I thought it was my headphones. There you go. I think you muted yourself. I thought it was
do you
my
know where I
headphones.
muted myself?
No.
Okay, well, that's good.
Sorry.
Um, well, let me start again because I think it's very important. So, asking yourself, has the thesis changed? Was
Yep.
I talking about the company that grown by 500% or not? Had I gotten to
Yep.
that?
Yep.
Or
Yep. You go there.
yeah, okay.
Yep.
So I've got no idea where I muted myself, but really considering like, has the thesis changed? So what I was just talking about was Chamath Palihapitiya, who's a kind of very famous VC, billionaire VC.
Mm.
I watched a podcast with he was on 6-8 months ago, where he said he was actively divesting from all his software as a service companies that he owns or that he's invested in because the thesis had changed, because AI is taking over all of the coding function and therefore is undermining the competitive advantage that those companies have. So asking yourself, has the thesis changed? Has anything changed about this that would, and so a shift in demand is a reason to consider, has the thesis changed? The demand profile might be changing for a suburb. If the demand profile wasn't changing, maybe you wouldn't move out, maybe you wouldn't consider selling, right? Maybe you'd be like, well, demand's still crazy high. Let's keep going. Before we move on from that point though, or before we move on, the other thing you have to ask yourself is, would you buy this asset again today at the current price? It's a really important question to ask yourself, because let's say you were like us and you bought a property in Goodna at $280,000 in 2019, and now the properties are worth $650,000 in that suburb. The question you should ask yourself is, okay, but if you've got a property and it's worth 650, you should ask yourself, would I buy this property for 650,000? Do I think that this is a good place? Like, would I do this? If I came into the market now, would I buy this property for $650,000? Do I think that there's enough upside in that? And just sort of run that mental exercise to go through that. If the answer is no, then, hey, great time to consider rotating out of the asset. Now, liquid assets are in some ways more advantageous than illiquid assets like real estate, because you can layer out. So, for example, let's say you bought $10,000 of stock, and it went up by 3x, right? And it was now, let's say you bought $10,000 of a stock worth, you bought 1,000 shares that were $10 a share. So you bought $10,000 worth of the stock, right? Let's say the share price goes up to $30 a share, right? You could reasonably ask yourself, oh, like, would I, based on my thesis, based on my understanding, based on my research, based on my analysis, would I buy this today at $30? And you might say, no, but I also still believe that this could be a good opportunity. So maybe you sell down in layers. Maybe you don't just go all in or all out, because I think actually going all in or all out can also be a big mistake. So you could layer out. You could say, okay, this has tripled in value. What's the likelihood it's going to triple in value again? I'm not sure. Maybe I'll take out my original $10,000, let the other $20,000 ride. Or maybe I sell 50%, and then I just leave it alone. And I'm willing to take the punt because I've taken out the original capital plus 50% return or something like that. Or you can kind of like layer out. That's one of the benefits of liquid assets, is you can take some profit. You can take your initial capital out, take some profits, and then let the rest of it sit there and just go for it whilst you go and redeploy the capital. It's one of the benefits of more liquid assets. But still, fundamentally, the thinking is the same. Would you buy the asset for today at that price? Yes or no? Has the thesis changed? What's shifted? These are some of the ways you can start to think about this.
Yeah, I was thinking, how can we apply that with real estate? Because obviously it's like you own it or you don't own it. You can get leverage, obviously, but in terms of liquidation, how do we approach it there?
Well, that was specifically my point, is that it's a lot easier in liquid assets. So it's very, you can't
can't really,
you can't layer out of a property. You know what? I'll sell a third of the property. I bought it for 200.
Chuck some bricks on marketplace or something.
Yeah, I bought it for 200. It's worth 600. I'll sell 200 worth of it, leave the other. It doesn't work like that at all.
Yeah.
Now, one of the things to consider though is the redeployment of capital and how you might think about doing that. Now, this is interesting. It's kind of related, but the question you should ask yourself is: let's say you've identified, let's say you've got a property and you're like, okay, I bought it at 250, right? It's now worth 500. It's doubled in value. Awesome, rock and roll. What do you do? Do you instantly sell it? Do you instantly say, oh, well, right, I think this is at the end of its cycle and I don't want to sit here and do you sell it or do you refinance it? It's a very interesting question, because you could refinance all the equity out of it, take that capital, redeploy the capital, and hold the asset. Now, the challenge you'll have with that is what you may end up with is a zombie property. You'll end up with a property that basically has no available equity in it, that's kind of just drifting sideways, and you're holding. And, now there may be reasons to do that. Like there may be some sound reasons to that. Maybe you just fundamentally don't like the idea of trading properties. Cool. All good. Like in trading in real estate, you're not trading in days and weeks and months. You're trading over years. You might buy a property, hold it for a few years, and then sell it and redeploy the capital. But you just might not want to do that. You might just say, nah, that's not the type of investor that I am. So no, I'm not going to do that. That's fine. You may say, you may still actually be convinced that there's like a sort of 50-50 chance that you're still going to see, 50% more growth in that suburb, in which case you're like, I'm willing to hold the asset to expose myself to the opportunity for more growth. I don't want to sell it down, but I do want to make sure I realize some of the gains. And you may want to refinance the equity out at that point so you can realize some of the gains. Now, where this gets tricky is understanding your borrowing potential and understanding what that will what impact that will have on your ability to redeploy capital in the future. Because let's say you bought 5 properties. Let's say you've got $1 million of equity in your property portfolio, right? Let's say you've got $1 million of equity in your property portfolio, available equity, but you've got no borrowing capacity left. Or then it doesn't really matter because you can't access any of that equity. Or you got $250,000 of borrowing capacity. Maybe you could refinance $250,000 of equity out of your portfolio, but then what? You actually can't get a loan to go buy another property. So you actually may need to strategically sell down so that you can release some of the debt, as well as capitalize on those gains to redeploy that capital. Because that's actually going to be the biggest roadblock for most people, is they may own 4 or 5 or 6, if you work with Dashlot at least anyway, you might own 4 or 5 or 6 properties, right? Most people don't get there, but Dashlot clients do. So you may own 4 or 5 or 6 properties, and you might be looking at some of those properties and going, okay, now's a great time to sell. Actually, you know what? We're comfortable selling. We've made 400% return on invested capital over 4 years. We've smashed our hurdle rate. We're stoked. Let's go. And then what's that?
So not just like the way we casually say some of the returns that our clients get. It's casually.
Yeah, totally.
100%. Yeah.
Yeah, exactly. And so, and you may turn around and say, well, actually, you know what? Let me use an example. Let me share my screen one more time. So this is an anonymized client's portfolio.
Where are you going with this? Oh yeah, cool.
Yeah. So this is an actual client's portfolio. We've anonymized it, so you can't see their property addresses or their names. So we're not going to give away.
Can you just in the bottom left?
Yeah.
Next to your face. Yeah, just close that and make it bigger.
Sure.
Cool.
So this is a real client portfolio. So they have a PPR, they have a unit, they have 3 investment properties they bought with Dashdot. So that in total they've got 6 properties. Now in their portfolio, now we calculated just on the Dashdot properties, they've generated a 376.2% return on invested capital in the last 2021 was the kind of first one. So in the
3
last
years or something.
4 years, which is crazy, right? So they've had an amazing return. Their current borrowing capacity is $250,000. You can see here that they've got this property here is worth selling potentially in the next 1 to 3 months. This property here in the next 3 to 6 months. This property here in the next 1 to 3 months. Now, they could refinance the equity out of these properties because there is a ton of equity in these properties. If we look here, available equity, they got hundreds of thousands of dollars of available equity, but they've only got $250,000 borrowing capacity. In fact,
which is the constraint here for these guys.
Yeah, so they've got this is great. Actually, I know this is actually funny.
Yeah, $1 million of equity. There you go.
Yeah. So they've got $1 million of equity and they got $250,000 of borrowing capacity. So they're in a position now where they get to go, well, what are we going to do? What are we going to do? Because they can't actually effectively use that $1 million of current equity without selling down some of the properties and unlocking the debt. Now we've identified that also this unit, which we didn't buy with them, but we analyzed that and said, hey, look, this is probably an opportunity to sell down as well. So they could potentially unlock about $700,000 of capital and $700,000 of borrowing capacity, which would put them at about $1 million of borrowing capacity and about $700,000 of capital. Now that is going to put them in a great position to then go and find the next opportunities in the next markets to get in at the right time. And this is how they're going to continue to expand and compound their return on invested capital.
Yeah, it's interesting as well to think about here, because we've obviously got the sell signals coming through, but that's based on the location basis, and it's factoring in. It could be, if you were to consider selling this asset, now could be a good time, but also considering, you need to consider the whole portfolio and consider, like, do I even want to do that? How is my portfolio looking? What are my constraints? How am I tracking towards my goals? And also, like, maybe I just want to hold it. Maybe I'm just comfortable writing it out, waiting for the next kind of upturn. Maybe I want to hold it forever. Like, a lot of people own their PPR, the home that they live in, and they're not considering selling, but they're interested in how the growth is changing over time. So getting these kind of sell signals for those areas might be helpful, but they're not actually like, okay, I should think about selling soon.
Yeah. Yeah. It's an indication to start thinking about it. It's an indication to start making some assessments. And it's an indication to sort of go, okay, cool. Now that I've got some signal, what does that mean? Now let me start to form an opinion. What is my thesis here? How am I going to think about it? How am I going to think about capital allocation? I want to touch on a couple of questions I can see in the chat, or a couple of comments. NQ said, I find that bank values are so generous these days that it's worth using that leverage to buy the next one rather than paying the costs on sale to exit. And that's a really important consideration. It's a really important consideration, but that is also subject to you being able to continue to refinance the debt. Because very broadly, I agree with you that it is economically more advantageous to refinance the capital out of those assets and then redeploy the capital and continue to hold the assets. But what if you find the edge of your borrowing capacity, at which point then you actually just may need to sell down the assets to release some of that debt. So there's definitely an arbitrage play there, because I agree that bank valuations tend to be higher than what we tend to see in a market when you go get an appraisal. So there's a reality in that. So if you wanted to play that game, you could potentially effectively get more money by leveraging, by refinancing the properties potentially, right? Not financial advice, of course, but you may find that you get to the end of your borrowing capacity, and then you've got to really consider: do you continue to hold effectively zombie properties that have got almost no equity in them, that are just sort of drifting, or do you sell down assets, deal with the fact that you pay the cost, the exit costs, and then crack on and redeploy the capital and the borrowing capacity into the next property? A lot of people freak out about capital gains tax too, but it's very important to remember that capital gains tax is lower than your income tax rate. So I would rather take a capital gain than generate cash flow personally. So do you have any comments on that?
Yeah, I think, like, with it, when we're doing these portfolio reviews for clients, so I'm feeling very casual today, hence the leaning and the face touching. But
It's okay.
I'm tired. Got in late last night. When we're doing these reviews, we are not financial advisors, not financial advice. And you genuinely, in terms of like calculating CGT, it is an accountant function. It's not a thing that we can tell you, you're going to pay this exact dollar amount in CGT. But we do factor it in as an estimate, because it is something to consider. It's like, if you go and sell an asset that you've potentially bought with us, we want to know that at the end of the day, most likely, if you get like the CGT discount, if you're going to get that or not. And like, after all costs and after you've paid CGT in your next tax return, right, which there's a delay there, which people should factor in as well. What do you net out in cash wise compared to what you put in? And so we are factoring that into conversations. And again, it's thinking through, like, okay, if I put in 50 grand into this property, and then 2 years later, after all costs, it's grown, I've sold, there's sales costs, I've paid CGT, but I come out with 150 grand.
That's awesome.
That's an amazing result. Awesome. And then you can take that 150 grand and you can put that into potentially a better positioned location or a different asset.
Yeah,
so it's
you use that for a deposit for another property.
Yeah.
And by the way, if you do that, which is very common, to get those kind of results, you've just beat every professional asset manager on planet Earth, right? Like you've just become in the top 1% of top 1% of investors of any type on the planet. Like, I think it's very important to understand. But timing is really, really interesting consideration, particularly around CGT as well, because you do want to make sure, well, you have to consider whether or not you're going to get long-term capital gains, short-term capital gains. What impact might that have on your total return? And this is why looking at the return on invested capital versus your hurdle rate is probably the most important metric you can think about. Not how much has the property grown or how long have I held it. It is, what is the net return on invested capital versus my hurdle rate over that period of time. But also one of the considerations you might have is specific timing of when to sell, right? If you're looking to sell a property around the middle of the year, are you better off to sell it on June 29th or July 3rd? Well, July 3rd would be better because you're going to push that sale into the next financial year, which means that you're going to delay the CGT payment timelines and all of these other kind of things as well. So thinking about timing is quite important. It's a really important consideration of how to decide when to sell, because tax events do matter. They do have a meaningful impact. One final one before we kind of wrap up as well. Panda Chicken right in here. We're looking at upsize. Do you think it's better to sell and restart with equity from the new PPR, or hold on to everything with a larger PPR mortgage? Selling our 3 properties, 2 investments plus PPR is roughly 500K. Now, I don't know that I can answer that specifically, right? But what I would like to do is leverage that question, parlay that question into kind of a sort of a different line of thinking, which is interesting. Because if you own a PPR, the interest on your principal place of residence mortgage is non-tax deductible debt. So one thing that people can consider doing, which a lot of our clients are actually looking at doing this now. And in fact, the example portfolio that I just had up on the screen a second ago, these clients are actually looking to do this as well. You could potentially sell down your investment properties, take the profits, use that to pay down the principal place of residence mortgage, then refinance out of the principal place of residence to then use that to go and buy investment properties, and then your interest expense becomes tax deductible. Of course, not financial advice, go speak to an accountant, yada, 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 all that stuff. But that's a concept called debt recycling. So now in terms of the upsize, I mean, that's a very personal kind of consideration, and I'm not sure that I can provide good advice on whether you should upsize or not, or how to think about that. But one of the things you can do is consolidating the debt on your principal place of residence to reduce the principal place of residence mortgage. Splitting the loans out to then go buy investment properties means that your interest expense on your principal place of residence, in theory, according to go speak to your accountant, would be tax deductible. So that's an interesting way you can think about parlaying these ideas together to start to form an opinion of how you might play that out strategically. When it comes down to, like, should you buy investment properties, should you buy a PPR, should you sell your investment properties to go buy the home of your dreams, these become very, very, very personal decisions. And by the way, I think everyone should just make the right decision for them personally. If it's more important for you to own a bigger family home and you're upsized and you've got the home of your dreams, if that's more important to you than accelerating your wealth, which would effectively be what the decision is, then awesome, rock and roll, go do that. Or is it more important for you to scale up your wealth? In which case you may want to consider renting the home of your dreams, rent vesting, right? And deploying all of your capital into investment properties instead, or into other assets. So thinking that through I think is really, really critical.
Yeah, I was looking at another client. I might pull it up because it's a different example. I know we're running short on time, but it's a different example because it's a client that early days with Dashdot bought 1 property, and doesn't matter how many properties you buy with us, we continue to track them. Okay, now I'm multitasking. This is good. Share screen, add to that guy. Cool. Okay. Because I was thinking about, obviously we're focusing a lot on like market timing and looking in the charts in Pathfinder and the metrics in there as well. But it is also thinking through like this particular property, right? This was in Jan 2020, right? So everyone knows what happened after that point. But purchase price, 330 grand. Current value, right? 1 property is 740,000. And so that's based on bank vals. So whether or not they could go and sell that property for that amount right now.
Take off 10%, right? So that'll kind of get you pretty close to the. So even if you knock that down to like 600 and even if you knock that down to like 660, right? You've still doubled the purchase price.
Yeah. And so this is a consideration to factor in as well, right? Because like the investment was 57K.
What?
And so the ROIC is 710. I'm not trying to like showcase the amazing results. I'm just thinking through like this particular client put in 58K and then has held it. You know, obviously probably through the COVID boom, probably could have considered selling, but has held it. And so this is an example of a longer term play.
Yeah.
Where also now there's less of a consideration of if now is the right time to sell or not. Now they can just kind of go, okay, well, there's, you know, I don't have to loan them out for this particular client in here, but let's just say that's, I don't know, they've got
500K or something.
500K of equity. It's less of a consideration of, is this the right time to sell? It's just like, okay, there's 500K in there. Do I want to take that out?
Yeah, exactly. And also even from a selling perspective. So let's say that location was past its peak. Let's say actually it peaked at $900,000 valuation and now it's dropped down to 740. Does it matter?
Yeah.
Like, is that client going to be heartbroken that they missed the peak, or are they going to be happy they got 710% return on invested capital? Because again, it's really about measuring that against your hurdle rate and going, okay, am I progressing at the rate at an acceptable rate? So I think this is an awesome example because it kind of highlights the fact that if you kind of get it right and get the right returns, you can be less sensitive to, am I selling too early? Am I selling too late? What does this look like? You can start to really just lean into, am I beating my hurdle rate? Am I getting an appropriate rate of return based on my objectives and goals? Am I moving, and start to make effective decisions in that way? So I think that's great. That's a great example. What stupid results. It's awesome.
It's pretty wild.
It's almost offensive.
Are you offended? I'm offended. Cool.
All right. Well, I think that's all we've got for today. So let us know in the comments if you like this topic. Let us know if you wanted to cover more stuff like this. Also, leave in the comments suggestions of things you would like us to cover, because we're super up for crafting content based around what you guys want to hear as well, what you guys want to see. And obviously, we can talk about property stuff. We can talk about all kinds of different things. So let us know in the comments what you want to see more of, whether this hit a note with you. In the description, I always say show notes because I'm so used to like podcast vernacular, but it's like
it's both. There's still show notes on Spotify and Apple, so
okay, show notes. YouTube video description, if that's what it's called. You'll find links to Property Pathfinder. You'll find a link, I think, to be able to apply for a portfolio review. Again, just be patient if you do sign up for that as well. And until next time, I think that's it. I think that's it.
I think that's it. Yeah. Awesome.
All right, guys. Great to see you. Great to spend some time with you. Happy Friday. Have a wonderful weekend, and we will see you next week.
Bye.